Hey, this is your January market review. So for those of you out there that have not seen these videos before, the reason that I put these videos together each month is to give my clients the straightforward information with no media spin, political angles, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this is to just give my clients the straightforward information about what's going on in the stock market and the economy, and ultimately how that affects their investments and their money. The stock market was up 8% as measured by the S&P 500 index through February 2nd. This has continued the first couple days of the month of February because of a big move here post the Federal Reserve meeting that was February 1st. The bond index is also up about 3% year to date as well, as measured through the Barclays index. That is also through February 2nd as well. According to Ned Davis research, when the S&P 500 posts a gain in January, it goes on to rise an additional 8.6% on average for the rest of the year. This is based on data going back through 1929. So obviously that's no guarantee. That's just an average that typically the market will gain another 8.6% after the month of January if it's positive in that month. So I thought that was a little interesting fact that I came across here this past month that was something to pass on to you guys. The rebound has been led really by the worst performing areas of the market of last year. So that was technology stocks, consumer discretionary stocks. So those are areas like Amazon and Tesla are two of the largest stocks within that sector, and both of those have done extremely well to start out the year. Communication services is also an area that has done extremely well this year, and that is led or has been led here a lot by the move in Meta or Facebook, the parent company for Facebook, their stock. This has been a good example of really why you don't want to time the stock market, meaning moving money from stocks into cash and then from cash back to stocks. It's better to stay invested long-term versus trying to time the market in that way, thinking you're gonna dodge some small little gyration. Typically that doesn't work out well because you have to be right twice. You not only have to be right when the market is gonna drop, but then you have to be right when the market is bottoming as well to put the money back into the market or into a position. So I don't advise that. I don't manage money in that way. That's something that, I talk a lot about, of just having your money invested with a long-term philosophy in play. So one of the big reasons that stocks moved higher is because of the Federal Reserve getting closer to being done raising interest rates. Jerome Powell had a press conference February 1st and made it clear that core inflation is going down. And, that's definitely something that is super positive for the overall markets, because if inflation is going down, that means that they can slow the rate or completely stop raising interest rates, which raising interest rates helps slow the economy down and isn't a great thing for stocks in the short term. Okay, I have two charts that I want to go over with you today that I thought were interesting. I want to keep this as a little bit of a shorter video so that way it's a little bit more concise, to the point, with really good information. So there was one chart that I've referenced a number of times I thought is something good to kind of bring up to show at least where the economy is at because of what they've been doing with interest rates. So the first chart here that I have is small business job openings. So this is a measurement of the positions that are not able to be filled right now. So this has spiked up dramatically over the last couple of years since COVID, where it was over 40% of jobs that are available that could be filled. Small businesses just can't find the workers to fill those positions. Great sign for the economy that there are that many jobs that are open. Not necessarily a great sign for small business, because that means that they can't fill those jobs and grow their business and do the production that they could otherwise. So it's a good sign to see, though, that it's come down from those peak levels, because there was, if you guys can remember here over the last couple of years, there was a lot of really great opportunities for people to change jobs, which is great for an employee, not great for the business itself, and long term not something that's super sustainable if businesses can't really have a good way to hire and fire people if they always just are having to, pay more and, move up that pay wage. That ultimately then moves on to consumers because they end up having to pay more for the products or service that company's making, which is the biggest driver in inflation and has been over the last couple of years. So the fact that that number has come down a lot is one of the main reasons that you'll see inflation has started to come down a lot. So thought that was an interesting chart just to bring up. I've referenced that a number of times here over the last couple of years, but I just wanted to bring that up just to kind of give you guys an update on that. Bigger chart that I wanted to talk more about is this next chart here, which is a chart of the S&P 500 going back over the last 10 years. So what you're looking at here, the movement in the S&P 500 is that blue line in there, which is just measuring the day-to-day jumps, movements within the overall market. Those green bars that are drawn in there, I drew in there as trend lines. So the reason I did that is I just wanted it to help train your guys' vision of really what you're looking at and see a little bit more of like some things that I look at behind the scenes and give you a better feel for where markets are at and likely where they're heading. So pictures, I feel like, do that a lot better than me just talking about it. So you can see this chart over the years has bounced between the lower end of the green range and the upper end of the green range, going off of the bottom and then eventually going to hit the top. And these are straight parallel lines. So, they're not perfect where it's always going to hit the top or always, just stop right at the bottom. There's the time during 2020, during COVID, went straight through that. During 2018, it went through that as well. Back in October here, it also pierced that just slightly. So it's just a general trend line, at least to give you an idea of where things are likely going. So we're at the lower end of that trend line, and we've bounced up here a good amount to start out the year. But based on that trend line, there's still a lot of room to run. So, and I bring this up because it's very easy to get kind of sucked into the day-to-day or month-to-month or even quarter-to-quarter view of looking at your account and being like, wow, it really hasn't moved that much, or I'm still down from where it was the beginning of 2022, which if you were a client of mine or really anybody that had money invested from stocks to bonds to really any asset class outside of cash, you're down from where it was the very beginning of 2022. So, but we're heading back in a higher direction now. So not to say it's going to be a straight line because it never is, but this is a trend line that'll show you the upper end of that range, which really only goes out a few months from here, will show that there's a lot more room potentially to run with this. And we've really done a lot on the downside as far as markets pulling back in preparation of a possible recession, which, based on Jerome Powell, the Fed chairman's press conference on this past Wednesday, February 1st, there's not a lot of data out there that is pointing to a clear and obvious recession, kind of like back in October where there was a lot more data of the more obvious sign at the time looking like there would be a recession, that we were already possibly in a recession, or there are areas of the economy that were in a recession that we're going to then roll over to other areas of the economy. Now a lot of that has kind of worked its way through. There's still some potential risk out there with more hurdles to jump as far as the economy goes and inflation coming down, but it's a good sign to see that things are at least progressing in that. So that is my half glass full chart here for the month, to just give you a little bit of optimism of not just the fact that obviously the markets went up a lot in January to reverse some of the losses of 2022, but also a good sign that things are, looking pretty good to continue the year and move forward from here. I will say that we're not going to, more than likely not going to go up at 8% per month clip. So would not be surprised to see some sort of give back on that over the next couple months to at least some degree. But it's a good sign seeing that markets have rebounded the way that they have in the beginning part of the year. If you have questions, don't hesitate, call, text, or email me. More than happy to answer any questions that you have. If you have friends or family members that you think would be interested or benefit from having a conversation with me, please get us in touch. I'd be more than happy to just have a conversation with them to see where I may be able to help them out or just give them some general guidance. If we aren't meeting here this month via Zoom and you'd like to meet via Zoom or just have a conversation to go over your portfolio, don't hesitate to reach out to me. I'm more than available to do Zoom meetings here this month. I appreciate you all for taking the time to check me out. Until next time.